Here we are, in front of 1, 2, 3, 4, too many students in front of me, all carrying, what are you carrying? You're carrying torches and a ramrod. So if
pitchforks, would be the term.
Pitchforks. So if at some point during this recording my voice trails off into a blithering mess, you'll know what happened. Okay, the first question was, Company R purchases a patent for $30,000 with a remaining life of 15 years. 2 years later, the patent is challenged in court. The company has to pay $5,000 in legal fees to defend. Here's what we go through. What do you do first? A, prepare the entry for the acquisition. Simply debit the patent cost, credit cash for $30,000, and the annual amortization is $2,000 each year. That's 15 years, no problem. If you got that right, I'll give you 90% of the problem. Well, maybe not. Number B, the patent is successfully defended by the legal fees, so those fees now add to the amortization for the remaining 13 years, so your amortization goes up each year to $2,385, round it. If you didn't round it, that's okay too. Then, C, we assume that now the patent defense was unsuccessful. So what happens here? In the third year, everything gets written off. What was remaining on the patent was $30,000 minus 2 years of amortization, brings it to a net of 26, plus the $5,000 legal fees. That all goes towards like loss on patent, $31,000, or if you broke it down 26 and 5, that's okay too. If you didn't credit cash, that's all right. Also, if you got the idea that everything's written off, there is no further amortization, that's the end of the patent. The next question is, Company V, or 5, has the following assets and liabilities, and then they give you a listing of fair market value and book value. The key is the fair market value, because that's what you're going to pay for. It's an asset sale. You're going to pay for the assets based on their fair market value. The fair market value of the assets comes out to merchandise 9, machinery 25, that's 34, plus land, that's 60 for the land, makes it 80, 94 in total, and then accounts payable reduces the net assets by 5 to an 89. So to buy all the merchandise and to assume the payables in an asset sale, you would have paid $89,000 as fair value. That would have been the normal. But then you paid $100. Why? Are you a fool? No, there was goodwill, $11,000. End of discussion. End of the Chapter 12 quiz. If you did well on that and you didn't do well on the final, I don't have anything to say.